Welcome to today's stock analysis, where we will analyze the two stocks Alibaba and Amazon. Our focus is on assessing their intrinsic valuations using 5 distinct valuation models. By employing these analytical methods, we aim to uncover potential investment opportunities and identify compelling valuations. Let's dive into the intricate world of stock analysis and discover what these insights reveal about today's stocks. Now, we've seamlessly integrated the ticker symbols for Alibaba and Amazon into our spreadsheet, automatically importing the relevant stock data. Examining the 365-day graph, we observe a fluctuating downward trajectory in Alibaba's stock price over the past year with a loss of nearly 15%. Whereas Amazon's stock price has increased almost 90% during the last year. Shifting our focus to valuations in comparison to target prices, Alibaba appears to be approximately 42% below the mean analyst target price, signifying potential undervaluation. Amazon aligns more closely with its analyst target price, but still with a 19% difference, again showing a potential undervaluation. Both stocks exhibit an RSI in the span of 55 to 65, indicating a somewhat balanced state with neither being oversold or overbought. Now, let's delve into a more detailed analysis of the intrinsic values for these two stocks, utilizing the 5 distinct intrinsic valuation models embedded in this spreadsheet. This exploration will provide a comprehensive understanding of Alibaba and Amazon's intrinsic valuations. Our first stop in the realm of intrinsic valuation brings us to Graham's revised valuation model, a creation of the legendary Benjamin Graham. This model enables us to determine intrinsic value based on 3 key inputs: earnings per share, the anticipated growth of the company, and the current yield of a AAA bond. Fortunately, our automated spreadsheet streamlines the process, requiring only the addition of the company's projected growth, readily available on platforms like Yahoo Finance. Upon incorporating the projected growth for Alibaba into this model, the intrinsic value calculation yields only $42.61. This indicates that Alibaba's intrinsic value has a difference close to 44% to its current stock price. Applying the same methodology to Amazon, the intrinsic value computation results is $95.46, revealing a similar difference of 45% relative to the current stock price. Moving on to our next valuation model, we explore the Peter Lynch Dividend Adjusted Fair Value Model. In this method, the Peter Lynch fair value is determined by adding the earnings growth rate and the dividend yield, and then dividing the result by the price-to-earnings ratio. The output is a value either above or below 1, where a value below 1 suggests an overvalued stock, while a value above 1 implies an undervalued stock. Upon applying this model to Alibaba and Amazon, both stocks exhibit a Peter Lynch fair value below 1, indicating that they are currently overvalued. To refine this assessment, we perform additional calculations, although I won't delve into the specifics in this video, to derive a more tangible fair stock price. For Alibaba, this computation yields a fair stock price of $16.03 due to the very low growth estimate. This value is significantly below its current stock price. Similarly, Amazon's fair stock price is calculated at $42.71, once again coming in lower than its current stock price. Now, let's delve into the comparable company analysis, also known as the multiples valuation model. This approach involves identifying companies similar to the one under scrutiny and utilizing their price-to-earnings ratios to calculate intrinsic value by multiplying with the company's earnings per share. In our analysis, I've included comparable companies for both Alibaba and Amazon. Focusing on Alibaba, the intrinsic value derived from this model stands close to $189, almost 150% above the current stock price. This is due to Alibaba's high earnings per share. Shifting our attention to Amazon, the calculated intrinsic value is only approximately $72, more than 50% below its current stock price. This comparison unveils interesting dynamics, suggesting that Alibaba is currently trading at a valuation under its industry peers, while Amazon might be experiencing a moderate overvaluation. As we continue to explore diverse intrinsic valuation models, we aim to paint a comprehensive picture of the true worth of these companies in the market. Now, normally we would explore the dividend discount model, a method that delves into a company's dividend payouts over recent years. However, Amazon does not pay out dividends, and Alibaba has just paid out its first dividends to shareholders this year. Therefore, this model can't be used on these two stocks. We will then move on to the discounted cash flow model. This model values a stock by estimating its future free cash flows, discounting them to present value using a chosen discount rate. It then factors in total debt, adds cash and cash equivalents, and divides the result by shares outstanding to determine the intrinsic stock value. For Alibaba, we can source the necessary data from Yahoo Finance, including cash and cash equivalents, total debt, shares outstanding, and free cash flow data available online. When we integrate this data into the model, the intrinsic value calculated stands at $382. Remarkably, this is 400% over the current stock price. On the other hand, applying the same methodology to Amazon, the model yields an intrinsic value of $150, which is 14% under the current stock price. Of note, Amazon experienced a negative free cash flow in 2021 and 2022, which decreases the viability of this model. These diverse intrinsic valuation models provide us with a comprehensive perspective on the intrinsic values of Alibaba and Amazon, offering valuable insights for investors seeking a deeper understanding of these stocks in the market. In the summary section, we've assessed and compiled all calculated intrinsic values for Alibaba and Amazon, making strategic decisions on which valuation models to include in the final calculation. Using the average intrinsic value for the 4 applicable models, the mean intrinsic value for Alibaba is $158, which is close to double the current stock price. Acknowledging the inherent uncertainties of both the models and the Chinese market, a margin of safety of 30% is incorporated, leading to an acceptable stock price of $110, which is still above the current stock price. In case of Amazon, the decision to exclude the dividend discount model refines the intrinsic value to $91, almost 50% under the current stock price. By applying a margin of safety of 20%, the final acceptable buying price hovers at $72, significantly below the current stock price. In conclusion, of the 2 analyzed stocks, Alibaba presents the most attractive buying opportunity. However, it also comes with considerable risks due to the economic situation in China and the current geopolitical environment with friction between China and the USA. If you found value in this video, don't forget to hit the like button and subscribe. It truly goes a long way in supporting our small channel. Thank you for being part of our community. Closing this video, I'd like to highlight that the intrinsic valuation tool featured in this analysis is available on my Patreon page, along with a complete valuation list of all stocks analyzed on this channel. For your convenience, you can find the link to the page in the video description below. Now, a crucial disclaimer: I am not a professional financial advisor. The stock analysis presented on this YouTube channel is intended for informational purposes only and should not be construed as financial advice or a recommendation to buy or sell any stocks. Always conduct your own due diligence and seek professional advice before making any investment decisions.